Attendees are in listen-only mode.
So welcome everybody to the next installment of the OurCrowd Teach-In Tuesday. I am aware that it is Thursday, but this is a special event for us. I'm your host, Zack Miller. I'm a partner here at OurCrowd, and we have a very special guest today, Dan Ciporin from Canaan Partners, who's going to not only talk about, and Dan, by the way, I'll let him introduce himself. He has I believe one of the hottest hands in investing in fintech in the market right now. Dan will tell you about his portfolio, his investing experience, but the real crux of the conversation is going to center around what's happening now in online lending. Dan sits on the board of Lending Club. Lending Club just experienced a massive IPO. Dan is also working with a company that OurCrowd is actively investing in, Borro. He will talk about that as well. I think it's a fantastic opportunity with one of the foremost experts in the field for our investors and for people who know OurCrowd to get to know a little bit more about the industry. Before I turn it over to Dan, just a question, just a little bit of housekeeping. We do record these episodes, so if you registered for tonight's event, we'll follow up with an email. Hopefully Dan will let us use the slides as well, we're recording the session, so you'll be able to review it and on your own time. If you have any questions that come up during the event, we'll have the opportunity to ask Dan questions at the end of this. So Dan's going to present for about 45 minutes. That'll leave about 15 to 20 minutes of questions and answers. You can submit those via the questions panel in your GoToWebinar panel. Without further ado, let me introduce Dan Ciporin and let him present on fintech. Dan.
Thanks, David. Zack, appreciate it very much, and thank you, OurCrowd, for letting me have the opportunity to present to all of you. Thank you all for listening. So I thought I would just start with a basic overview of Canaan Partners before diving into the world of fintech or financial services, financial technology, which is, as was described, really being transformed lately in very, very exciting ways. And we'll talk about a few of those ways that it is being transformed shortly. Just to start, though, with Canaan Partners overview, where I've been for the last 7.5, 8 years. We just announced a Fund 10. We've been around for almost 30 years now. We are just raised Fund 10, which we're starting to invest out of this month, which is $675 million. The total amount of funds that we have under assets under management is about $4.2 billion. So we are a relatively large venture capital firm. We invest in a variety of different sectors. Technology is the primary sector we invest in, 67%, but healthcare represents about a third of our portfolio as well. We are early stage investors. We really focus on early stage seed. Series A is sort of our sweet spot, but we do also have a portion, about a fifth of our investment strategies centered around mid to late stage. We've done pretty well over the last 25, 30 years. We've had 57 IPOs, actually 58 with Lending Club just last month, 110 M&As, and 12 exits in just the last 12 months alone. We have a variety of different themes that we think about investing in. I tend to invest on the top end as the consumer portion, if you will, of how we think about investing, and that's on the e-commerce side, the marketplaces side, and the fintech side. And then on the bottom here you see the enterprise focus that we have, which is big data and cloud. I just wanted to touch on those because the main topic of today is clearly on the fintech side, where we really tend to center our investment focus on sort of three key themes, namely that of crowdfunding, lending alternatives, and then overall payments and digital currency. Just to give a brief background on myself so that you know who I am, where I come from, and how I think about investing. My background is that I was first at MasterCard International, where I was Senior Vice President in charge of all global debit programs there on the online side, namely the Cirrus ATM network and the Maestro point-of-sale debit network. And from there, back in 1999, I dove into the wonderful world of the emerging internet and became CEO of a company that was called Shopping.com. Took that company from zero to about $130 million in revenues, took it public in 2004, and then sold it to eBay in 2005 for about $620 million. I should note that one of the very first backers of Shopping.com was a wonderful gentleman by the name of John Medved, who many of you know, and who, of course, is founder of OurCrowd. And John has been a very dear friend ever since, and not to mention an extraordinarily good investor. And I think this platform, that is OurCrowd, really represents that. When I dove into the world of venture capital coming out of the Shopping.com environment, what I did, my very first investment was an idea, an incredible idea from an incredible entrepreneur who also had $0 in revenue at that particular moment. Renaud Laplanche was the entrepreneur and founder of Lending Club, and that was my first investment in 2007 at Canaan Partners. And one of the interesting things about that experience was the fact that, back in 2007, when you were thinking about disruption, you tended to think about advertising. Google, of course, being the primary disruptor in the advertising market with the way that it had reinvented search, if you will, and advertising around search, and the IPO, of course, happening just a couple of years before that. Nobody was really thinking about financial services and financial technology as an area of disruption. That has changed. It's changed pretty dramatically, in part because of the Lending Club experience, which, as you all know, had a very successful IPO last month and is now roughly $9 billion or so in market cap. But I think that is really a forerunner of many, many, many interesting things in this sector. That is the sector of financial technology, or fintech. And we are invested in a number of different companies in the fintech environment, not just Lending Club, but Borro, which, as was mentioned earlier, OurCrowd is really helping offer for an investment opportunity to all of you, as well as Circle Up, which is another consumer product goods crowdfunding platform, OurCrowd, which is a connector to for institutional investors into all peer-to-peer lending platforms, Shopkeep, which is an iPad-based payments company, and Itbit, which is a Bitcoin exchange company. So those are just 6 representative examples of some of the fintech investments we've done. With that, maybe what I can do is turn now to the fintech opportunity overall, which really is changing the world of money itself, I believe, in again, fundamental ways, but particularly on the banking side and the way money has been handled and intermediated traditionally. So let's just start. I mentioned ad tech. Ad tech, which as a prominent example, obviously Google is one of the foremost disruptors of the advertising technology market, which in the United States alone is $165 billion. That's a very big market. But when you think about the world of financial services, you're looking at a market, a total addressable market, or TAM, of about 150 times that amount. It is an absolutely massive, massive market, which has been very, very legacy protected, primarily by regulatory moats. We start to see a lot of that being broken down now as technology has started to come into the world of financial services, abiding by and embracing regulation in a way that wasn't done before, and providing very unique technology differentiation from what has traditionally been done. And again, the size of the market that you were disrupting here is so massive that when people say, I've heard often that this sort of a little bit of a cliche that says, fintech is the new ad tech. Well, fintech is the new ad tech times 150. Again, you cannot understate the size of this market and the amount of disruption potential that it offers. And Lending Club is probably one of the great, as I say, one of the first maybe examples of this, but certainly not in any way, shape, or form the last. There will be many others. But when you think about Lending Club, Lending Club is the 4th largest, not just a large IPO, but it's the 4th largest internet IPO in history, U.S. internet IPO in history. There are 3 others that were larger, Google, Facebook, and Twitter. Lending Club is the 4th after that, and it is the single largest IPO of 2014. So again, fintech is not some fad. This is a big, big deal It's here to stay, and it's just beginning. You know, just talking about the size of the market, you can see that there's lots and lots of areas for disruption here, and that again, the overall fintech market, this is U.S. only again, so massive that, you know, the opportunity set here is so big that you can have many companies that are operating within this environment that can be winners. And one of the interesting things, there are a number of interesting dynamics about the financial sector. I'm going to walk through a couple of those right now. Again, be happy to take questions afterwards on anything here. But one of the interesting facts about the financial sector itself is that you know, when you look at other sectors, and by sectors I mean you know, economically, statistically trackable sectors like wholesale and retail, you see that when you invest in technology, CapEx, if you will, that overall prices go down, productivity goes up. You see this in the wholesale trade on the left. You see this on the retail trade in the middle. The fascinating thing to me is that you don't see this in financial services, or have not traditionally seen this. You see lots of CapEx, but no productivity gain. And that is a pretty astonishing dynamic, which I think is representative of the fact that there are just enormous legacy impediments to financial services adopting, you know, true state-of-the-art technology to offer really, really unique services in a way that's you know, that's efficient in the same way that the internet has enabled so many other efficient aspects of disruption in the marketplace. Everything from, you know, not just Google, but Airbnb and Uber and all the other sectors that are being disrupted are being disrupted by being able to have and utilize the internet in ways that are very unique. This has not yet happened in financial services, although it is starting to, and you see this, again, very macro chart representing that fact. You also see that the lack of innovation in the overall financial services sector has started to impact margins, but it's been going on for a long time. If you look at this chart with the net interest margin for U.S. banks, you can see that you know, probably not coincidentally, margins peaked in the roughly in the year 1995, which was also the year that the internet first came along. If you think about the internet start as the launch of Netscape in 1995, or certainly the World Wide Web and the browser, you can see that margins have been declining ever since. There was a brief uptick right after the Great Recession, but again, it has continued the overall trend downward over the last few years, and looks like it will continue that way because there simply is not much in the way of true innovation going on in this sector right now, within banks, I should say. And in fact, you see that there's been a significant reliance by banks on equity trading volume, or trading volume in general, as a way to drive up margins. And this is, in fact, one of the reasons why you have such vociferous and intense lobbying on Dodd-Frank to kind of let some of these regulatory pieces that constrain banks from doing their own proprietary trading. You can see that this really is very, very tough for banks, because it's how they've been making all their money as of late, and certainly when you look back at the last 10, 15 years in particular. Regulation has increased the pressure greatly on banks. I'm not going to walk through this slide in any great detail, but what I will say, and what you can see very clearly here, is that, you know, when you go from a spectrum of 88 up to 2010, you see more and more regulation happening. You see that you have you know, the requirements on Basel 1, 2, and 3 have become ever greater as far as common equity is concerned, and also in particular as far as the amount of capital reserves that are required are concerned, and that has impacted banks in terms of margins, and they have not been able to innovate their way around that. The next slide shows really more of the same, if you will, in a different format, which is essentially showing that return on equity in Europe and North America in particular has dropped dramatically over the last 15 years or so, or 10 years, excuse me, and much of that has really been driven by the need to add to reserve requirements. And the corresponding lack of being able to innovate around adding to those reserve requirements. And this is where innovation has come into play by outsiders, by disruptors, by true entrepreneurs on the technology side. And Lending Club is a great example of that. As you can see here, the cost structure for a traditional lender has huge elements of costs embedded that Lending Club, for example, and many of the other disruptors in the financial services sector simply don't have. Branch infrastructure and reserve requirements are clearly two major cost centers, if you will, that Lending Club, for example, simply does not have to deal with. It's an online-only service that is fully compliant, operates through a bank, but does not in and of itself have a reserve requirement because fundamentally it is a marketplace operating through an existing bank. But perhaps even more interesting is the fact that of all the components that a traditional lender has as far as cost structure is concerned, customer acquisition, underwriting, origination, and servicing, the technology that you can apply to each of those cost sectors, if you will, can bring down the operating expense of those specific processes down hugely by as much as 50% from what a traditional or legacy lender would provide. So you see that there are sort of two innovative pressures here on traditional banks. One is some of the regulatory pieces of reserve requirements and branch infrastructure, and secondly is simply the cost of actually fulfilling a loan are so much greater when you're not innovating in the same way that some of the disruptors coming into this space have done and are doing. And it's not just peer-to-peer lending. You can see here another example in a very different space, the remittance space, where a company called Zoom offers the ability to remit currency across borders, all online, with no physical locations at margins that are 50% higher than traditional Western Union, which requires having physical locations to offer remittance payments, is able to do. So you see these kinds of financial disruptions happening in many different sectors, many different industries. Personal asset-backed securities also being yet another example, and this is where Borro comes into play. Borro, of course, is a technology expansion of a market that has traditionally been done only, only on the physical side, only on the offline side, and now you have a technology enablement platform that's able to allow for loans against physical goods, but have those loans actually be originated online. And a fascinating thing about, I think, Borro, one of the many fascinating things about Borro is that effectively the principal and interest rate losses over the last 4 years have been zero, meaning that while there have been defaults on the order of about 10%, on an aggregate basis, the recovery of those defaults against both principal and interest has been more than 100%. And in fact, this is not only a fully secured loan, but from the standpoint of the track record, there's been no loss of any principal or interest again over these last 4 years with Borro. You have 2014 revenues of about $20 million on $73 million of total originations, about a 70% growth rate, as well as an automated appraisal system, which is really fundamentally, if you will, their underwriting system built upon 45,000 historical appraisals with extremely attractive lifetime values where you have enormous amounts of repeats and very, very sticky customers that come back over and over again to the site and to the service. So when you think about the many different ways that financial sector and the financial services area can be disrupted, you see that there are in this graph almost a broad array, a map, if you will, of lots of different sectors where disruption is happening, not just on the consumer side, not just on the small business side, but even in now verticals which are, you could call them verticals, but they're massive, massive verticals. Real estate vertical is, also a $1 trillion potential sector in terms of total market size. Education, massive, obviously. Even solar companies doing alternative energy lending, a very, very large sector. So there's just many, many sectors here that are being disrupted, that this overall market landscape slide, if you will, is trying to represent, again, in a pictorial way. But I think the message here is very clear, which is this market is evolving before our eyes, and disruption is happening, and innovation is happening right before our eyes. And you can look at just the peer-to-peer lending sector alone, and you see this happens to be this particular slide, or this particular set of data, I should say, happens to come from a firm in the UK called Liberium. But they're saying, based on their own analysis, they looked at just 5 players in the P2P sector, or peer-to-peer or marketplace lending sector, and just in the UK and just in the US. And their forecasts are for this to be over 500 billion. On the left it's pounds, but in terms of US dollars, over 500 billion in 10 years from just these 5 players alone. And when you add in all the other players, you're talking about potentially close to $1 trillion in alternative finance and marketplace lending sectors that were only a blip in somebody's eye just a few short years ago. So just to summarize on the presentation, maybe to just wrap up with this particular presentation, and then maybe go to some of the Q&A. There are many, many opportunities in the financial services sector, in the fintech area of disruption, where things are just beginning. And from an investor standpoint, many, many companies emerging that are going to be extraordinarily profitable and extraordinarily powerful from an investor return perspective. This is a massive market. It is not a billions of dollar market. It is a trillions of dollar market. There is no question that there is a very significant lack of innovation from incumbents. You simply have legacy players who have been, in some ways, you could even say barnacle encrusted by the regulatory moat that they've had, which is starting to be disrupted by players who actually embrace regulation. Renaud Laplanche, the CEO of Lending Club, his background is a fascinating one, in that he was a corporate securities lawyer before becoming an entrepreneur and starting an enterprise company, which he sold to Oracle, and then starting Lending Club. And having that background, that combination of that knowledge of regulatory issues combined with entrepreneurial zeal is the kind of thing that makes winners in this space. So there is a lack of innovation from incumbents that entrepreneurs are now attacking very directly and embracing the regulatory piece that has traditionally kept a real moat around some of these banks and financial services companies. And then, as mentioned again, the regulatory environment is starting to really lift startups up, both in terms of the depression in margins that it's causing banks, but also on the fact that you have now regulations that are really enabling and helping entrepreneurs. The Jobs Act, as you know, is a very, very important act in terms of freeing up alternative lending and alternative equity investing platforms, as well as the whole marketplace lending regulations that have gone into place since 2009 that have really enabled this industry to arise. There's lots of regulatory tailwinds on the alternative lending side that are really quite important in terms of driving innovation. And fintech itself is simply an area that we will look back on, I believe, 10, 15 years from now and say this was the beginning, this was the start of a whole new revolution in financial services driven by technology and the internet. So with that, Zach and David, I'm happy to turn it over to you for any questions that anyone might have, or to talk any further about any of these specific points.
Thanks, Dan. That was really great. Very insightful. We have a lot of questions coming in. I think what we'll try to do is start more macro and global and then get more focused as we go. So
Sure.
the first question is, what is the best or better economic climate for the types of lending activities? So do you actually think that alternative lending online is better or worse in a down market?
So I think I would answer that question. I think it does depend on the type of company and the type of market that the company's addressing. For Lending Club, let me start there. For Lending Club, because Lending Club is a marketplace, the interest rate environment should not matter in that sense, meaning if interest rates are rising, then those interest rates that are being offered to borrowers will rise along with the interest rates that are being offered to investors. If those interest rates are declining, then the opposite situation will occur. So remember, Lending Club is really a marketplace that responds to market dynamics. In either way, the fact is that the marketplace rates that are being offered are reflective of that environment. So I don't think that as far as Lending Club is concerned, you're going to have much impact either way. People will need loans no matter what kind of economic environment you're in, and the question of what price you pay will be regulated, if you will. Not regulated in the legal sense, but controlled, if you will, by the marketplace. With respect to a company like Borro, in many respects, you could say that a downward shift in the economy would probably be more helpful in some ways to Borro, where you have a situation where cash and liquidity becomes more dear, but assets are still there. So the ability to actually monetize assets becomes more important. In a down market, I would say that you potentially could have a scenario where a company like Borro could actually find that environment one that would propel growth even more. So I think it really depends on the kind of company you're talking about, but certainly, in a marketplace company, you're going to have that piece of it controlled by the marketplace, the pricing. And in a company where it's focused on lending against assets, a down environment probably will increase the demand for those services.
Great answer. Thanks so much. So another kind of macro trend prediction question. You talked a lot about there being different verticals of online finance that are emerging, but if you kind of think more towards the future when the online credit markets will be a little bit more saturated, and the competition then will be for the supply on the supply side of capital. And I'd have to imagine that there are certain types of lending that will emerge as just having a better overall risk-adjusted return. And if that's the case, and if there is limited supply of debt capital online, how would this impact the growth potential for different online credit products?
So if I understand the question correctly, I think the basic assumption was that that the amount of capital that would be available to alternative lenders would, in an environment where it would be less than it is today, what happens? Is that fundamentally the question?
No, not necessarily less than there is today, but let's say that as there are more and more platforms and the demand is continuing to grow, I guess if at some point demand growth is faster than supply growth, which verticals of online credit products do you think that would then suffer from that in terms of their growth potential? Does that make sense? Meaning, again, this is a question that came through, but I think what the investor is asking is if on the supply side they're looking at diversifying across different online credit products, and different credit products have different risk-adjusted returns, and ultimately if they have to make choices as to where to deploy their capital, and if the demand for capital is greater than the supply, I guess which which credit products do you think then would ultimately suffer in terms of growth? Like right now, we seem to be in an environment where there aren't constraints, right, on supply or demand. But if we ended up hitting up against those barriers, I guess that's the question. I don't know. Do you have any thoughts?
Yeah. So okay. I think I can answer that. So a couple things. First of all, risk-adjusted return is an interesting concept, and it's one that that each investor ultimately will have to determine for themselves. When Lending Club, as an example, a marketplace example, offers a centralized risk quantification process, if you will, where you can choose to invest in A loans or G loans, and there's risks and associated pricing attached to those. Now, what a marketplace lender like Lending Club or Prosper will do is simply say, this is how we rank the risk, and this is why we are ranking the risk this way, and this is why we are pricing it this way. So, an A loan will be, to a borrower will be 5-6%, but almost zero defaults, and a G loan will be 19%, but 5, 6, 7% defaults. And so obviously in a bad economic environment, you're going to have to weigh out whether or not that G loan will have higher defaults and therefore a net return that will be less than you might expect versus the A loan. And so you're trying to really make a determination as to which net return is going to be better for you. But that again is marketplace lending does not take out the risk-reward equation in investing at all. It simply tries to make it more transparent. So unlike a bank where you simply put in deposits and that bank then invests those deposits for you in some kind of risk measurement and risk allocation methodology that they alone have and utilize, you get a set fixed deposit interest rate back, a very low one. Here you're being matched up to your risk desire, your risk tolerance with what you think matches up to that in a marketplace lending scenario. So I think it's the whole point of a marketplace lending platform is to offer transparency around how risk is being measured and why, and what the pricing around those risks are, and that is that is really then up to an individual as to how much risk they're willing to take on the risk-reward spectrum. But I think it's a much cleaner way of offering that trade-off to investors than any other mechanism out there. Does that answer the question?
Yeah, that was a great answer. Thanks very much.
So Dan, another investor asks about government regulation as peer-to-peer or marketplace lending grows in popularity. What are your thoughts about increasing chance of governments sort of coming in and regulating these entities as banks going forward?
Well, one common misconception is that a company like a lending club is not actually being regulated, and if I in any way gave that impression, then that would be my mistake, because the reality is that Lending Club works through a bank, web bank, and has to comply with all the same regulatory requirements that any bank would have to comply with respect to how it's marketed, with respect to making sure that there's no no discrimination in terms of the offers for different loans, with respect to all the federal and state regulations that exist out there that any bank would have to comply with. Lending Club also complies with, or anybody that works with a bank would have to comply with. So there's no regulatory shackle that gets put on banks that doesn't get put on a marketplace lender, with the exception of the reserve requirements. But that's simply because there's also no federal deposit insurance that that a marketplace lender, Lending Club, is offering. There's not a lot of other things that that a bank traditionally would offer. So all the regulatory compliance issues that that any bank would have to comply with as far as offering loans to borrowers are also true for marketplace lenders.
Great, thanks, Dan.
So we had one question about, in general, as these fintech marketplaces start to expand globally, can you talk a little bit about the foreign currency exposure? I guess that would be different for a marketplace, versus a balance sheet lender. Just in your experience, does that become an issue as these companies scale internationally?
Yeah, I think it certainly could. The reality is right now you have investors, for the most part, investing in, for example, a UK-based marketplace, Zopa. They would be investing in pounds and being paid in pounds, so you wouldn't have a situation where you'd have to take currency risk. Having said that, I don't think there's any question that there will be an opportunity for investors to invest in, if you're in the U.S., to invest in UK or Europe, any other European country, or an Asian market for that matter. And again, your risk reward will also be dictated not just by the credit of borrowers that you're investing in, but also on the FX side. But offering the ability for an investor to do that, I think is very exciting, and I think is coming as these platforms scale. No question about it.
So speaking of currency, Dan, a couple investors asked about Bitcoin. How, as an investor, a fintech investor, what are your thoughts on the virtual currency, cryptocurrency?
Yeah, I think, from my standpoint at least, I think the most exciting thing about Bitcoin is not the currency piece of it. I think that I think that's a very, very interesting piece of it. But I think the whole blockchain technology itself and what it can be utilized for is probably the more fundamental revolution that would happen related to Bitcoin. The blockchain is kind of an audited ledger, if you will, that is distributed, and so if you can actually implement through math the ability to trust any given transaction that happens, because you can have it verified, again, mathematically. And I think that part of the technology is what's fascinating to me. I think the currency part is also very interesting, but I think there obviously been a number of issues that have gone on recently with respect to the currency. I think regardless of the currency and the evolution of the Bitcoin as a currency, the evolution of blockchain technologies is one that's going to, I think, is going to be a very, very big deal.
It's interesting because, I mean, Bitcoin and blockchain, but a lot of people don't even know about the concept of blockchain, has come under a lot of scrutiny. Do you think that's a failure in, education, in market education, or awareness, or understanding? What's the issue here? Why is Bitcoin really struggling?
I think that I think a couple things. First of all, I think you're going to have, in the very near term, we really don't have a fully compliant exchange at this moment in time. For example, a currency exchange with Bitcoin, where you can freely exchange Bitcoin that has that is fully compliant with all regulatory or all regulator requirements around doing so. It's a pretty onerous process right now. I do think that is going to, I would say this year, in fact, I think we will have the first U.S. blessed, if you will, by regulators, I mean, regulatory blessed Bitcoin exchange. I think that'll happen, I would actually place a bet on it happening before this summer. And I think when that happens, you will have a lot more comfort with the not so much the technology, but the currency. And I think because you don't have that right now, it introduces a lot of fear and distrust into the system that just won't be there if you have a regulatory compliant exchange and ability to freely transact Bitcoin in a way that that regulators are okay with. So again, there are a number of Bitcoin companies that have applied for licenses. They're going through the process. I think that you'll see at least one, if not several, get approved in the very near term, and I think that will change things significantly.
Cool. So you talked a bit about how you're an investor in Circle Up, which is crowdfunding for consumer goods. You also had nice things to say about OurCrowd, which we appreciate, obviously. We want to get your opinion on another area of crowdfunding, and that's real estate crowdfunding. So a few of the investors have sent through questions. Curious as to what your position is or take on the opportunity in real estate crowdfunding is.
Sure. We love real estate crowdfunding. We are invested in a company called Realty Mogul. That's part of our portfolio, which is in fact a real estate crowdfunding platform, and is doing extremely well. What that offers is an ability to, similar to a marketplace lender, an ability to choose the type of real estate investment you want to make, both in terms of the type of asset, meaning an equity or debt investment, and the type of property, and to have that investment be governed as though it were a direct investment, which it is essentially, a direct investment in the real estate property, meaning that all the tax benefits of owning real estate would accrue to you as an investor in this crowdfunding platform, unlike a REIT, where you obviously don't have those same kind of tax benefits because it's more of an indirect ownership. So, having the ability for people to choose the types of real estate investments they want to make. Do they want to make, in Realty Mogul, we just offered a chance to participate. I think the minimum, I could be wrong on this, but the minimum I believe was $10,000. It might have been 20, but a minimum of $10,000, I believe, on the Hard Rock Hotel in Palm Springs. But you also can invest in a renovated house in Santa Monica, California, for example. Or you can invest in a multi-tenant apartment building in upstate New York. There are many different types, and the ability to invest and to put in money. The ease of doing that is phenomenal. It's very automated. One of the interesting things, Jillian Hellman, who's the CEO of Realty Mogul, one of the interesting stories she tells about her early days starting the company is that she wanted to call around to people that were investing to just make sure that they were okay with the process. And she talked to one person, and he said, why are you calling me? And she said, well, I'm calling just to try and understand if you had a good experience and how it was. He goes, I had a great experience, but I don't want, but the fact that you're calling me lessens that experience because I don't want to talk to anybody. That's why I wanted to do it online. And I think that says something about just how easy it is to invest online and to do all your own research, to make your own risk-reward investment calculations, and to do that, in a fully automated fashion. I think that this is the type real estate crowdfunding, for example, is the type of experience that you can have in that regard, and I think that's certainly not limited to real estate investing, but or crowdfunding. But I think that's a great example of how innovation is coming to investing overall. The reality is that most people don't necessarily have access to lots of different kinds of investments that have traditionally been centered among a very few people, and crowdfunding in general offers that opportunity to participate in very, very interesting investments that people would not otherwise be able to do. and that is true certainly for real estate crowdfunding as well as consumer goods product crowdfunding that Circle Up offers, and technology crowdfunding that OurCrowd offers. I think they're all parts of the same coin, if you will, which is tremendous innovation in the financial sector, and tremendous ability to now invest in and access assets that ordinarily, or even as little as 5 years ago, you would never be able to do. I think it's phenomenal.
So Dan, very interesting. You've really made bets with leading brands in each sort of subsector of crowdfunding, whether it's realty with Realty Mobile or marketplace lending. You mentioned OurCrowd, and a couple investors sent through that. Wow, that looks really interesting. Can you sort of describe what OurCrowd does and what you view sort of the future for that type of maybe marketplace aggregation? Going forward.
Sure. So OurCrowd is an absolutely fascinating investment. It's not only fascinating; it's doing incredibly well. They've gone from zero to almost $1 billion of assets under management in just under a year, which is one of the fastest rates of growth we've ever seen. It is an extraordinary company that really is part of the emerging ecosystem for this whole explosion and growth of alternative lending. And so what OurCrowd does essentially is for institutional investors primarily enable them to simply go online and to decide to set their parameters for risk and the types of loans that they want to invest in, and then be able to invest in those loans across different platforms. So to be able to invest in those loans in Lending Club, in Prosper, in Funding Circle, in OnDeck, on and on, and eventually in Borro, eventually in lots and lots of other lenders out there that are balance sheet lenders. But the real ability to enable an investor to access the entire universe of origination platforms out there, and to be able to do that through one interface, through one site, and to be able to set all the parameters that are good for them on risk reward, and to manage their entire portfolio easily, quickly, with all the access to analytical tools and data that you might need in order to do that, and to do that again across the entire universe of origination platforms, of which there are now hundreds. So, it is in many respects the one-to-many plugin, if you will, from an investor standpoint. Investors can plug in and then access all the origination platforms that are out there and do it easily, quickly, seamlessly for the investor.
Yeah, OurCrowd sounds definitely fascinating. In the remaining time that we have, I think we should shift gears to talk about Borro a little bit, because we have a lot of questions on Borro. So the first one is just at a high level, can you compare Borro with other successful investments you've made in similar areas? Like, what are the commonalities of those companies? And what is kind of your specific and Canaan specific interest in Borro? Sure.
So, one of the things that we look for is the ability to, can you take a I'm going to say underwriting process, but I mean that in a very broad sense, which I'll explain more fully in just a moment. But can you take an underwriting process and differentiate it and scale it in a centralized fashion so you can enable it to happen online, and therefore enable a platform to grow quickly from the underwriting perspective? Now, one of the fascinating things about Borro that we found was that their underwriting, if you will, is based fundamentally on the appraisal process for physical goods. So they have honed over the last few years, and it's a very difficult thing to do. Again, particularly at scale, they have honed the ability to understand quickly what kinds of value attaches to what kinds of physical goods. And remember, ultimately, the underwriting, quote-unquote underwriting here, is really lending to the asset. It's lending to the person, but you're lending against the asset, not against the person's credit score. And so, in effect, you're underwriting the asset and the value of the asset. And being able to do that, with a track record that they have, which is again zero, a full principal and interest back every single time, or at least in an aggregate sense. There are defaults, but on an aggregate basis, always being able to deliver full principal and interest returns is remarkable. And if you think, in fact, one of the big opportunities with Borro is, we're right now at a 12% balance sheet cost of capital. If you look at an A loan, which is an unsecured loan on Lending Club, which is a very, very low risk loan, the default rates are absolutely minuscule, but it's still unsecured. You're getting somewhere in the neighborhood 5-6% in terms of what the rates are. One would have to ask if you have a fully secured loan where there essentially no on an aggregate basis, no losses. Shouldn't you have a cost of capital that approaches somewhere in that vicinity? And I think that that's a real opportunity for Borro going forward, because they do have, if you will, a specialized underwriting expertise. The underwriting being around assets and the value associated with assets, and it is differentiated. We haven't found, there's really no one else out there that can do it at scale in the way that Borro does. And I think that having that centralized, differentiated underwriting capability is very important, and that's something that Borro has in a very different and unique way.
Sorry about that, Dan. So we had a few investors come through with very similar questions about sort of the future for Borro, like, sort of where you see it in the next 18 months. It is a marketplace. It is a balance sheet lender now. May they go into peer-to-peer? Can you just sort of talk about what the future holds for the company?
Sure. So I think that, as you noted, it is a balance sheet lender right now. And there's certainly, there's not necessarily, one can be a very, very successful balance sheet lender. But I think a marketplace, so I don't think inherently that's, that is a kind of a filter, if you will. But I do think that marketplace lending and the opportunity to have marketplace lending for a company like Borro could be tremendously valuable. And is one of the exciting, for me at least, exciting opportunities available to Borro. Again, in part because you can dramatically lower your cost of capital in the way that we just, in the way that I hopefully just was able to articulate. So I think that is very much on the roadmap. I think the great news is that I think a company like Borro doesn't necessarily have to reinvent the wheel, if you will, on the marketplace lending side. A company like OurCrowd could help them set up a marketplace lending platform, for example. And Borro has this very unique set of assets and set of loans that I think would be very, very appealing to investors in the retail sense. So I think that's absolutely one of the key focal points for the company moving forward.
One of the investors, and we have time for this last question before we wrap up the hour. Marketplace lending seems to be obviously taking share away from the incumbents. You started out your presentation like that. Do you see marketplace lending creating access to entirely new sets of assets? One investor mentions litigation finance. What's your thought looking ahead?
I'm laughing a little bit only because I literally had a company coming in just yesterday proposing exactly that, litigation financing for as a marketplace lending concept. And just as an aside, litigation financing, it turns out, I wasn't fully aware of this, although it sounds like you're the person who asked the question is, it's a $250 billion market. It's quite a large market. So, this is where I think, yes, marketplace lending can be applied to many different verticals. And You know, one of the things we as venture capitalists always worry a little bit about is when you start to get to things like, you know, when you start to hear too much of, you know, well, this could be the Uber of of one of your chihuahuas. You know, when you start to really get down to very, very niche types of derivative companies, you get worried about you know, whether or not that's really going to last. The great news here is that, you know, again, financial services is so massive as a sector that there can be very, very many winners, unlike in some other sectors, you know, where you know, even a $5 or $10 billion market sounds very large, but you know, if there's 20 companies trying to compete in that space, maybe it's not as large. In a financial services sector where you've got trillions and trillions of dollars of opportunity, you can have a lot of companies compete, and each of them can be very, very large. So there's lots of opportunity here, and I think again, unlike many other sectors, you know, when you start to have verticals, that litigation financing being a great example, $250 billion. You know, there's lots of those kinds of verticals that sound niche, but are actually very, very large. That a lot of these, you know, mechanisms of marketplace lending, being a classic one, can be applied to, and can be very exciting companies. So I think that the opportunity set here is just very, very large.
Great. So we like to be respectful of everyone's time and keep things to an hour. So with that, I'd like to thank you. We had a number of people, though, ask if we're able to send them the presentation. So I just wanted to ask you if that's okay. Is that okay with you?
Yes, that should be fine.
Okay, wonderful.
Yeah.
So we have the presentation. We'll be sending it out to all the attendees. Thank you all so much for joining. Thank you, Dan Ciporin, for a really educational and insightful webinar. We really appreciate it, and good night, everyone.
Thank you. Thank you all.
Good night, everybody.